let's start with the juice of this episode, which is, or like the core of this episode, which is we're going to talk about Series I savings bonds, and then also we're going to talk about expectations in terms of rates. So the market has certain expectations of rates, and those are expressed by future contracts. So you can actually buy futures where you make a bet. You say like, I expect the rate to be above 3.75 by this date, and that security is traded. Let's start with the Series I savings bond, and I'm going to share my screen. And if you could give like a little bit of a background of what it is, it'd be really helpful.
Series I bonds are bonds that you can buy online only through the U.S. Treasury if you're a U.S. taxpayer.
Yeah.
That you can only buy $10,000 worth per taxpayer. Not per taxpayer, per social security number or tax ID number. That's the key limitation here. So like we're going to talk about the expected rates of return and how nice they are. The limitation is that it's $10,000 per person functionally. So husband and wife each could buy $10,000 worth. You could buy $10,000 worth for your kids. You could buy $10,000 worth for your business, etc. But that's the key ceiling. The key feature of these is that they pay a fixed rate of interest and a variable rate of interest, both of them stacked together. And they pay those, the variable rate is based on the current inflation print. And for time periods in which inflation is printing high, you're functionally locking in quite a high rate of interest at present compared to other fixed income instruments because the CPI right now is showing as high. So this is an opportunity for anyone to evaluate their portfolio on the whole, their expected returns, and whether they could use a chunk of that to carve off and say, hey, I'd actually rather own this I bond that yields. I'm sure we can get into what the current vintage actually yields, but it's pretty high.
But how do they determine the fixed rate?
I can't remember exactly. It has something to do with broad government borrowing rates.
Yeah. And the inflation rate is just I guess here it says a consumer price index for all urban consumers, right? CPIU.
CPIU, yep.
Oh, so here the fixed rate was 0, and then the semi-annual inflation rate was 4.81. So they analyze it at 9.62. How dare they pay 0% of fixed rate?
A fixed rate, right? That's adorable. So this is a really interesting. So like if you have, for the record, you can't do this in a retirement account. So that cannot be done. You have to purchase direct through Treasury Direct. But let's imagine for a second that you own $10,000 of some stock that maybe you're sitting on a loss because it is today is May the 4th, 2022. A lot of stocks are probably at a loss for a lot of buyers. And you say, look, I'd rather reduce the volatility of my portfolio. I have $10,000 I could carve off, take the tax loss today, invest in an I bond, and lock in a really, really good positive rate of return. Do you think you defer taxes on these until you actually sell them? I believe that you do. I think you don't pay tax on these until the date that you redeem the bond to the
because I
Treasury.
think you get the interest when you redeem it, right?
Yeah, so I think interest is deferred here. So I think you're not paying. So for instance, in year one on $10,000, you might earn $900 worth of interest. But I think that we should look into this.
Interest is added to the bond monthly and paid when you cash the bond. So there's a reinvestment.
Yeah.
You're basically
look at tax
reinvesting.
Considerations.
Tax considerations, you pay you're subject to federal income tax, but not state. So I know that's the case for federal bonds usually.
Mm-hmm.
That's kind of like the whole idea that the states.
But is it deferred? So if I buy this right now, am I going to owe any extra tax for having owned this in 2022?
Yeah, 100%. It says it's put off, defer reporting the interest until you file a federal income tax return for the year in which one of these events occur. You cash out the bond, you give up ownership, or the bond stops paying interest because it has reached the final maturity.
There you go. All right.
And
So
how long are these bonds for?
I think they're like perpetual indefinite bonds. I don't think that they have a fixed maturity. Does that seem like that's the case?
Oh, interest earning period, 30 years or until you cash it, whichever comes first. I mean, so they're meant to really protect you from inflation. It's the composite rate for your 6-month earning period.
Yeah. So I bonds, pretty interesting. 10 grand per person. We just talked about this off air beforehand. This is probably a good purchase for your business and for my business for some of our working capital.
Yes, 100%. Specifically the stuff that I'm saving up to pay for taxes.
And liquidity is not as easy as, for instance, like an ETF or a stock where you're trading daily. I have been involved in a transaction where a client of mine was redeeming this, and it does require some. You have to interact with the Treasury Department to do it, so it might take a week to turn it around, rather than same business day for selling a stock or whatever.
If you actually redeem it before holding it 5 years, then you forfeit interest for the previous 3 months. That's an important point.
There's a lot more details that we could just read this whole page out loud. There's a lot more. I think any more just high level things. This is inflation protected. You're kind of locking in the interest at the current CPI that you buy at. There's another detail about if you use a tax refund to buy a Series I bond that you can buy more than $10,000 worth.
I mean, it's super interesting. I think there is a place for it, right? Because at the end of the day, it's much higher yielding than a savings account. I think from an educational standpoint, remember when we took all these tests? It's like the only things that are really guaranteed. There's very few of them, and it's like the federal government's credit and some insurance company products. You could actually advertise them as guaranteed, I think.
That's a place where you can get 9% and change, which is maybe the only one of those that I know of with no credit risk today.
Yeah.
Let's talk
you're
about
not staking any Bitcoins or anything like that.
Stop. Not related to that at all. Let's talk rates broadly. So what did you want to cover in terms of rates, rate expectations, where we stand today,
rates expectations? Yeah. Typically, like when you see this, you see like this. Okay. So let's take the June. It's like here, the June meeting is where the target rate, actually, let's go back to the May. Where do people or the market believe the target rates will be from the federal funds rate? So the federal funds rate, but just to back it up, the federal funds rate is the rate everybody talks about from the Fed that they raise or lower, right? It's the shortest end of the curve. It kind of is. Isn't it the rate that banks lend to each other or?
Yeah, it's a federal interbank lending rate, and it's overnight.
The Federal Reserve sets that amount, and they trade securities, so that remains the target. And through that, for being that such a short term, it affects the longer term rates, but has very little effect on the 10-year. It has more effect on the 5. It has way more effect on the 2. And they are on and then when you get to the lowest time frame, the overnights, they have a big effect. And so these rates usually set the precedent of what the deposits are being paid out eventually. It takes a little while for the banks to come up with or to hike their rates. But anyway, that's just a background of what the Fed funds rate is. Here, what we're looking at right now is the probability of where based on all the contracts that are in the market, the futures contracts, basically people are buying contracts, futures contract, where they think the rates are going to be. And so right now here, they believe the rates, by the end of May 4th, they're going to be at between 75 and 100 basis points. So that's 0.75% and 1%. And so I think right now they're standing at 0.25, right? And then we expect there to be a 0.5% increase. So therefore, you're in this zone. But the big question is when you go forward here to 15th of June, there might be 3 probabilities, right? One de minimis, and the other one is a little bit higher. Where do we think rates will be in after the June 15th meeting.
Sorry, pause here real quick on this. What we're looking at is market implied probabilities of rate ranges.
Correct. Yep. What I think is very interesting is when you go beyond this to, let's say, February 2023, now you have, a much more, looks like a bell curve, right? And these are the expectations today. So what's very interesting to see actually is like, okay, let's look at historical expectations versus today. And you can see here that currently the expectation is, like a bell curve. And then if you look at a month ago, which is the lightest one, the bell curve kind of like peaked here. And today it's peaking here, right? So the expectations have shifted upwards. And what that means is that, the expectations is not like, I expect this to happen. It's more like there's a probability set. So the entire curve shifted forward, and it's shifting backwards and forwards depending on the data, the economics that come out. But I think the shifts, to me right now, what's driving the market is, among many things, this shift in expectations. And a month ago, you had lower expectations of rates where they're going to end up in February 2023, and when the expectations of the rates shifted forward, into my understanding, that's what kind of drives the market down, because as interest rates go up, the cost of capital for a lot of companies go up as well, and financial conditions naturally tighten, and when they tighten, it slows demand. But what's interesting is,
let me translate this into my brokerage statement. This is why my bond funds are down.
Exactly.
My bonds are down. Why? Expectations of rates are up.
Yes. What's interesting is, like, I actually downloaded this image maybe this morning, and the picture is completely different. This morning, this bar was actually lower than the blue one. So, from yesterday, the rates have now shifted backwards. And this is like one day. And like, I can bet you that the market is up, right? So if I look at the market right now, it's up tremendously, right? 2 points, small growth is up 2.6, large value is up 2.6, and large growth is up 3.1. Essentially, if I look by the ETFs today, a large chunk of them are, I only have 3 ETFs that are negative. One is infrastructure, the other one is cloud 5G ETF, and some networking. But literally, this is an unbelievable day, and this is my opinion, is because it's shifted. The rates have shifted, the expectations have shifted.
This is the most important set of prices in markets by a long shot. Everything else is dwarfed by the importance of interest rates. I want to shout out one book, and I just looked up the name of it. It's an ebook, and it's by a hedge fund manager named Alex Gurevich. The title of the book is The Trades of March 2020. It's a short book. I think it's about 100 pages. I highly, highly recommend this because this guy's hedge fund, all they do is trade rates. It's a macro fund, and they trade extremely complicated and exotic products around rates. And if you ever got the notion into your head that you were smarter than this market of futures that Gabe just described and showed what's in it, this has actually chat logs. So his hedge fund uses Slack, and they use Slack logs to show what they were thinking and how deep they were around trading rates during COVID. It's an insane read. But the main takeaway that I have is, do not trick yourself into thinking that, you read something about, the Powell's going to do this or that, and that you can outtrade this market. This market is full of extremely well capitalized, unbelievably sophisticated and experienced people trading these rates. So yes, you can make personal financial decisions based on rates. Of course you will, but Please don't trade interest rate futures unless you really, really know what you're doing. You're going to get smoked by sharks.
People who have decades worth of trading and understand the players who are in the market.
There's a lot of structural stuff. They go cross border and they're trading, they're like, oh, the Bank of Canada is going to be forced to do X, Y, or Z. Let's get a swap from this. It's incredibly complex, but it's a really fun read if you're into this type of stuff.